Thanks so much, Julie, for that very warm introduction. I'm sorry not to be joining you in person today, but I'm very pleased and honored that you've invited me to speak at the event today. But before turning to my remarks, I'd like to pause for a moment to recognize the challenges that many Americans are facing in the aftermath of Hurricanes Helene and Milton, and the response and recovery efforts from the devastation of these two recent hurricanes. The effects of these disasters will likely continue for many months, and I'd like to thank the many volunteers, emergency responders, and service providers as they work to further the difficult work of response and recovery. Our thoughts and prayers are with those who have experienced the effects of these storms. But turning to community banking, I especially want to thank our event organizers today, especially President Goolsbee and the staff of the Chicago Federal Reserve Bank, the Federal Deposit Insurance Corporation, the Office of the Comptroller of the Currency, and this Conference of State Bank Supervisors for inviting me to share my thoughts with you at this 18th Annual Community Bankers Symposium. I always enjoy the opportunity to speak to bankers across the country and share perspectives on the issues that are facing the banking system and the financial system, especially when it's related to community banks. Banks are a critical component of the U.S. economy. Their work often extends well beyond the provision of credit, providing services and volunteer and financial support within their communities. Among many things, banks offer financial education, sponsorships, and funding for community programs and events. Without question, community banks are important and integral to the local economy. But community banks also face challenges that require proactive risk management, effective and efficient prioritization of compliance resources, and the need to innovate. So today I'd like to briefly highlight some of the issues that banks are facing and discuss ways that community banks and regulators can more effectively work together in the future. So I'm going to start with the challenges that community banks are facing, and many of this audience know these challenges well. Community banks face any number of challenges, and these are just a few, but they often rely on third-party service providers to offer products and services to your customers. It may be more difficult for you to hire and retain qualified staff or to plan for future leadership with management succession planning. Given limited staffing, you may be overwhelmed with the recent onslaught of new regulations and guidance. And in light of all of this, it may be challenging to prioritize resources in order to appropriately focus on the most important risks that are facing your businesses. While the headwinds may seem overwhelming, community banks are always resilient in the face of change. Often, one of the greatest challenges that community banks face is not about managing any particular risk, but rather how to address all of the risks that they face and how to prioritize the approach to address each of those risks. Regulators have at times exacerbated these challenges through policy choices. The risk of misprioritization is not limited to community banks. In my mind, this was most recently evident in the events and supervision leading to the failure of Silicon Valley Bank. Management failed to address growing interest rate risk and funding risks, and supervisors failed to prioritize and escalate these issues. Our goal should be to identify, understand, and learn from these past mistakes, and of course, to avoid repeating them. Both regulators and banks should be working toward a common goal, a banking system that supports economic activity throughout the country, in which banks operate in a safe and sound manner, and in compliance with consumer laws and regulations. In considering the challenges facing community banks, both regulators and banks have an important role to play. So I want to talk a little bit about competition. Community banks face competitive pressures from many sources. These pressures may result from local or regional economic conditions, the needs of retail and business customers, and the products and services that may be available in the market. Competitors can take the form of traditional banks, internet banks, and non-banks like fintechs and mortgage companies. While fintech partnerships can be beneficial to both the customer and the bank, if the relationship is not managed according to safe and sound banking principles, serious problems can result. When deposits are accepted through fintech relationships, but not handled appropriately, deposit insurance can be jeopardized, and the ability to access deposited funds may be impacted. But competition can also come from other local competitors, like credit unions, large banks with a broader operational footprint, payday lenders, or other non-bank credit sources. As bank customers grow increasingly comfortable and familiar with new mechanisms for doing business, the use of online banking has continued to expand. This has tended to increase the footprint of non-local banks or non-local bank lenders, non-bank lenders, enabling them to effectively compete for business outside of their geographic areas. But even against this backdrop, research shows that community banks have maintained an important role in many banking markets, including in small and medium-sized business lending. The regulatory framework establishes expectations for how community banks can compete, and it often creates an unlevel playing field with many of these competitors. This includes whether they're subject to the same regulation as banks that engage in the same activities, and how competition is evaluated. A core concept in financial regulation is to impose the same regulation, and I suggest that we expand this to include the same regulation, guidance, and supervisory expectations on entities that are engaged in the same activities. Banks compete against many non-bank providers, including financial technology firms, credit unions, and other non-bank lenders. In some of these head-to-head competitions, community banks face distinct disadvantages that can pose challenges when they're competing for the same banking opportunities. For example, banks are subject to taxes and additional regulatory requirements, including the Community Reinvestment Act. They're also subject to a broader range of restrictions imposed by regulatory requirements, or the soft power of supervision. In all of these cases, the disparity in the legal framework can have a distortive effect on competition. In short, where the financial regulatory framework can provide a parity of treatment, it should do so. The regulatory framework should not knowingly distort competition or effectively impose a regulatory allocation of credit. The framework also plays an important role in assessing competition among banks. The mergers and acquisitions approval process can have a disproportionate impact on community banks because the screens that are used to evaluate the competitive effects of a proposed merger often result in a finding that M&A transactions in rural markets can have an adverse effect on competition and should therefore be disallowed. Even when these transactions are eventually approved, the mechanical approach to analyzing competitive effects, which is grounded in the effect of proposed transactions on the control of deposits within individual banking markets, often requires additional review or analysis, and it can lead to delays in the regulatory approval process. I want to turn now to talk about cybersecurity. So community banks often note cybersecurity and third-party risk management as areas that can raise significant concerns. Cyber-related events, including ransomware attacks and business email compromises, are costly and time-consuming experiences, and they pose unique challenges for community banks. For example, the maintenance of and the technology resources required to support a successful cybersecurity program are often difficult for smaller banks. Regulators can promote cybersecurity and stronger cyber incident resilience and response capabilities by identifying resources and opportunities for banks to develop muscle memory in cyber incident response. Recent incidents like the CrowdStrike-related outage have highlighted the heavy dependence that many banks have on technology, third-party providers, and the broader supply chain. In the current risk environment, it's important for banks of all sizes to implement sound operational resilience, cybersecurity, and third-party risk management practices. One important resource for community banks is the FFIEC website, which includes the Cybersecurity Resource Guide and links to other cybersecurity resources. The Federal Reserve plays an important role in supervising banks and supporting risk management practices. For example, the Fed hosts the Midwest Cyber Workshop with the Federal Reserve Banks of Chicago, Kansas City, and St. Louis. Over the past 2 years, this workshop has provided a forum to further cyber risk discussions among community bankers, regulators, law enforcement, and other industry stakeholders. Today's symposium also includes an interactive cyber workshop, during which participants will participate in a cyber exercise working through the various decisions that would be required in responding to a hypothetical cyber attack. We all know well that cyber threats pose real risks to the banking system. We also recognize that community banks may have unique needs in preventing, remediating, and responding to cyber threats. Therefore, regulators should ensure that a range of resources are available to support community banks and seek further opportunities to help build community bank resilience against these threats. Third-party risk management can pose an additional challenge for community banks. Due to their size and scale, community banks often leverage centralized resources, technical experts who have greater expertise than the bank could fully maintain on their staff, to advise them and assist on a range of issues. Often these third-party service providers are significantly larger, and their bank clients, including smaller banks, may lack leverage in conducting due diligence and in negotiating the terms of their relationship. In 2023, the federal banking agencies published some supervisory guidance meant to address third-party risk management, which was expressly applicable to community banks. But as I noted at the time it was issued, the guidance included shortcomings that were known and identified, but they weren't addressed in advance of its publication. What many of you may not know is that nearly a year from the original publication, regulators published a guide to assist community banks to interpret and apply the guidance to their third-party risk management activities. This guide was intended to provide additional context for that guidance, including step-by-step examples of how to address third-party risk management, making the guidance more useful. And while I'm pleased that the Community Bank Implementation Guide was eventually published, the delays in its publication suggest a shortcoming in our regulatory approach. We must ensure that new guidance provides clarity to regulated firms on its own, or that we provide additional resources at the same time the guidance is published. So I'm going to address consumer compliance for just a minute. Like third-party risk management, consumer compliance can be another area that may present challenges for community banks, given their size and scale. An effective and well-run consumer compliance program balances consumer protection with the complexity and the cost to establish a robust compliance management program. One challenge for community banks is the difficulty in retaining qualified consumer compliance experts. Notwithstanding these challenges, community banks devote significant time and resources to their consumer compliance risk management program. Compliance with consumer protection laws and regulations, including fair lending laws, is essential to ensuring that the banking system provides fair and broad access to credit and to financial services. I know that community banks take these responsibilities seriously, and the overwhelming majority of banks that we supervise invest in very strong consumer compliance management systems to prevent any potential violations and to detect problems before they occur. When consumer compliance concerns arise, banks address them by making their customers whole and by adopting the necessary changes to ensure that the issues don't persist or reoccur. In a very small subset of cases, banks sometimes fall short of their obligations, and we hold those institutions accountable through supervisory actions or, in worst-case scenarios, enforcement actions. The Federal Reserve's Consumer Compliance Supervision Program is risk-focused and tailored to a bank's compliance risk, focused on the activities that present the greatest risk. One example related to third-party risk management is our recent system supervisory focus on consumer compliance risks that are associated with fintech relationships. As a result of this work, supervisors seek to identify the parties to relationships that pose the greatest risk of consumer harm. This effort helps to promote our understanding of higher-risk fintech partners across the Federal Reserve System, and it helps supervisors proactively identify the relationships that pose greater risk of consumer harm. There are a number of other core risks that are essential for bank management to address. These core risks, including funding, liquidity, and credit risk, should already be integrated into management priorities, since they pose the greatest threats to a bank's operations. Focusing on core risks is second nature for community banks. In contrast, supervision can be susceptible to diversion from core to non-core risks, leading supervisors to neglect the buildup of traditional risk. Diverting resources to non-core risks can often leave a bank vulnerable, especially when regulators direct banks to allocate resources in other ways, whether by regulation, guidance, or through supervisory expectations. So I want to turn now to risk mitigation for community banks. The design of regulation, guidance, and supervisory approach that regulators rely upon for community banks, and the intentional policy choices that underpin this framework are important for ensuring their effectiveness and supporting the safety and soundness of the banking system. These design choices can enable community banks to operate successfully while mitigating risks, leveraging tailoring, transparency, and consistency across institutions. I've spoken at great length, and I'm sure many of you have heard me talk about this already, about these themes in the past, but I would like to reiterate just a few of the critical elements of a regulatory agenda that will allow community banks to thrive into the future. So first, we need to revisit size thresholds over time, as inflation and economic growth slowly erode our regulatory categories. The bank regulatory framework is built largely upon asset-based size thresholds, and these thresholds should reflect a deliberate policy choice. But over time, these fixed thresholds effectively result in more firms being scoped in to higher compliance tiers over time, even when there has been no change in the bank's underlying risk profile. We need to have a regulatory system in which M&A transactions and de novo bank formations are possible for banks, not one in which regulatory approval requirements are used to impose additional and extra regulatory requirements on firms. Viable formation and merger options for banks of all sizes are necessary to avoid creating a barbell of the very largest and the very smallest banks in the banking system, with the number of community banks continuing to erode over time. Left unchecked, an applications process that imposes additional costs and delays on healthy and appropriate banking transactions will result in a reduction in available credit and services, and an increase in the number of unbanked or underbanked communities, and economic harm. We should prioritize direct experience in our regulatory efforts, giving greater voice and opportunities for input from policymakers with banking or state supervisory experience currently at the federal banking agencies, and by soliciting and accepting feedback from our state banking counterparts. Greater coordination and participation by a wider set of policymakers in regulatory reform efforts would bring several benefits. For example, discussion of competing ideas and compromise in the drafting of regulatory proposals often result in a more moderate approach, reducing dramatic swings of the regulatory pendulum. And in many cases, we can better anticipate the unintended consequences of reform proposals if policymakers engage in good faith discussions and coordination of these efforts. While regulatory reform brings many benefits, we should also shift our mindset to focus on the trade-offs of regulation, guidance, and supervision. Changes to the regulatory framework often yield benefits in terms of greater visibility into the workings of the banking system, additional capital that can absorb losses and promote financial resiliency, and more conservative risk management standards for interest rate risk and funding risk. But we need to evaluate not only the benefits of proposals, but also the costs and the unintended consequences. How will banks adjust their activities in response? Will they raise prices on lending activities or for other banking products or services? Will they exit certain low-margin businesses, resulting in greater concentration and increased financial stability risk? By considering the cumulative burden, we can better address and acknowledge these concerns. And finally, we must incorporate tailoring, calibrating the regulatory framework based on the size and complexity of banks' activities as a required input for regulatory consideration. Tailoring helps us to better allocate finite resources both in banks and among regulators, and it helps us avoid threatening the long-term viability of community banks by simply adding to the mass of existing regulations, guidance, and other supervisory material. We simply cannot ignore the cumulative or compounding effect of increasing the complexity of the regulatory framework, and we must make room in our reform agenda for the unglamorous work of maintenance and promoting an efficient framework. By no means is this proposal for regulatory reform exhaustive, but these critical components must be integrated into our future approach to ensure a diverse banking system for the future. So in closing, I want to thank you again for the opportunity to speak to you today and for your commitment to community banking. You serve a critical role within the banking system and in support of the U.S. economy more broadly. Your work to leverage the power of the community banking model enables you to serve customers, promote financial inclusion, and expand access to banking services. But policymakers have an important responsibility to make sure that the community banking model remains viable into the future. To function effectively, the banking system requires the presence of banks of all sizes, larger, regional, and community banks. This diversity of our financial institutions is the greatest strength of our banking system, and it can easily be imperiled by insufficiently targeted regulation, supervision, and guidance. Thanks so much.